You walk into a room where everyone is celebrating. Money is flowing like champagne. People are laughing, making toasts to their genius. The dealers themselves have started betting alongside the players. Everything looks perfect. Until someone who's worked here for 20 years leans in and whispers, "I've seen this exact scene 3 times before. Every single time, within an hour, this place was empty." Half these people ended up in debt for life. Would you listen to that person? Or would you convince yourself that this time is different? Right now, we're all sitting in that room, and what I'm about to show you in the next 40 minutes will either save you from financial devastation, or you'll ignore it like millions of others. Your choice. But remember, I warned you when the numbers still made sense. Let's start with one simple number, $38 trillion. That's the US government debt right this second. To put that in perspective, if you started counting $1 per second from the moment Christ was born, you still wouldn't have reached 1 trillion. We're talking about 38 of those. But here's what should terrify you. In just the last 2 months, that number grew by another trillion. 2 months. $1 trillion? That's $17 million every single minute. And before you think that's sustainable, let me tell you something that will keep you up at night. The US government now pays $1 trillion per year just in interest on that debt. Not paying down the debt itself, just the interest. That's more than the entire defense budget. More than everything spent on education, science, and infrastructure combined. And that number is about to double, then triple. Right now, the total US budget is around $6 trillion. Do the math. In a few years, interest payments alone will consume half of everything the government collects. Then what? How do you pay for the military? The police? Hospitals? Pensions? You don't. And that's when societies collapse. But stay with me, because this is just the beginning. What I'm about to reveal gets much worse. History has seen this movie before. The Spanish Empire in the 16th century controlled half the world and received tons of gold from their colonies. Infinite wealth, or so they thought. Spanish kings borrowed from Italian and German bankers against future gold deliveries. The gold arrived, but the creditors immediately seized it. Spain defaulted 4 times in 100 years. 4 times the richest country on earth said, "Sorry, we can't pay." Each time it triggered economic collapse, famine, uprisings. Then the gold ran out, and the empire simply ceased to exist as a great power. France in the 18th century made the same mistake. Versailles Palace, court luxury, wars in Europe and America, all financed by debt. By the late 1780s, the French government spent half its budget on interest payments. Sound familiar? When the king tried to raise taxes to close the gap, people took to the streets. A few years later, they cut off his head, and the country plunged into 20 years of chaos and war. Debt crises don't just destroy economies, they destroy entire societies. But maybe you're thinking, America is different. Modern economics works differently. The old rules don't apply anymore. Let me show you why that's the most dangerous thought you could have right now. And here's where it gets really interesting. Because I'm about to show you something that even most financial experts are missing. The total value of all stocks in the American market right now equals 363% of GDP. Let me say that again. Stocks are worth 3.5 times more than the entire economy produces in a year. This is a historical record. Even at the peak of the dot-com bubble in 2000, that number was only 150%. Back then, everyone said it was a new era. The internet changed everything. Old valuation methods don't work anymore. We remember how that ended. The market crashed 70%, and people lost trillions of dollars. But wait. Because what's happening now is even more absurd. The entire market growth over the past 2 years came from just 7 companies. 7. Out of thousands of publicly traded companies. Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla. They call them the Magnificent Seven. These companies are worth more than the combined economies of Japan, Germany, and the UK. And almost all this growth happened because of two words: artificial intelligence. Look, I'm not saying AI isn't important. It is. But when a company making AI chips is worth over $1 trillion while its annual profit is $50 billion, that means investors believe profits will grow 20-fold, 20 times, in a few years. Is that possible? Theoretically, yes. Probable? History screams no. Remember 2006. Everyone believed real estate prices would rise forever because land is finite and population is growing. Banks gave mortgages to anyone, even the unemployed. The logic was, even if they can't pay, we'll sell the house for more. The entire system was built on belief in infinite growth. Then in 2008, it turned out people couldn't pay their loans. Houses started losing value, and the whole house of cards collapsed in weeks. The world's largest banks went bankrupt or were saved by governments. The global economy contracted 15%. Millions lost their jobs and homes. Today, it's the same psychology. Except instead of real estate, it's tech stocks. People buy shares not because they analyze balance sheets and prospects, but because prices are rising and they fear missing out. This is called FOMO, fear of missing out. It's the most dangerous emotion in financial markets. When decisions are driven by emotion instead of mathematics, the end is near. But here's what nobody is talking about, and this is critical. There's one very simple indicator that never lies. It's called the Buffett Indicator, named after legendary investor Warren Buffett. It's the ratio of market value to economic size. Buffett said when this number exceeds 120%, the market is overvalued and dangerous. Below 80% is a good time to buy. Right now, it's 363%. Buffett knows these numbers. And you know what he's doing? Selling stocks and hoarding cash. His company, Berkshire Hathaway, is now sitting on $300 billion in cash. $300 billion. A record in the company's history. The world's most successful investor refuses to buy stocks at current prices. What does that tell you? But stocks are just the tip of the iceberg. The problem goes much deeper. And what I'm about to tell you will fundamentally change how you see the economy. The American economy is 70% dependent on consumer spending. That means if people stop buying, the economy stops. Latest data shows consumers are starting to cut back. Store sales are slowing. People are buying less clothing, less electronics, eating out less often. Credit cards are maxed out at historic levels. The average American owes over $6,000 on credit cards, with interest rates around 20% annually. That means people are spending more and more just servicing debt rather than buying new goods. Look at the job market. Official numbers say unemployment is low, just 4%. Sounds good, right? But the devil is in the details. First, most new jobs are low-wage service positions. Baristas, couriers, security guards. Second, the number of people working 2 or 3 jobs simultaneously has reached a 20-year high. That's not a sign of a strong economy. It's a sign that one job isn't enough to make ends meet. Moreover, the government regularly revises employment statistics downward. They publish beautiful numbers that everyone quotes in the news, then 3 months later, quietly admit the situation was actually worse. Just in the past year, there have been 4 such revisions, each time downgrading by an average of 100,000 jobs. Add up all these corrections, and the real picture is much grimmer than what we're shown. Here's a concrete example. A major retail chain recently announced it's closing 300 stores nationwide. 300 stores. Thousands of people losing their jobs. And this isn't an isolated case. Dozens of retail chains are cutting staff and closing unprofitable stores because customers aren't coming. Shopping malls that were packed with people just 10 years ago now stand half empty. Half the tenants have moved out. Yet the stock market is at all-time highs. See the contradiction? The economy is like a human body. You can pump yourself full of stimulants and keep going like Superman for a while. But if you're not sleeping, not eating properly, not letting your body recover, eventually the system fails. And not gradually. Suddenly. One day you're running marathons, the next you can't get out of bed. That's exactly what's happening to the global economy. It's been pumped full of trillions in artificial stimulus, and outwardly it looks strong. But internally, the destruction process is already in full swing. And what are the central banks doing about this? The ones supposed to manage the situation. They're trapped with no good way out. And this is where things get truly terrifying. Let me explain how central banks work and why they're now in an impossible position. Think of the economy as a car, and the central bank as the driver. The driver has two pedals, gas and brake. Gas means lowering interest rates and printing money to stimulate growth. Brake means raising rates to cool an overheated economy and stop inflation. After the 2008 crisis, central banks worldwide floored the gas pedal. They dropped rates nearly to zero. The Fed, European Central Bank, Bank of Japan, printed over $20 trillion in 10 years. $20 trillion. They injected this money into the system to prevent collapse. And for a while, it worked. The economy revived. Markets grew. Everything seemed under control. Then came the pandemic. And instead of letting the economy naturally cleanse itself of weak links, governments and central banks hit the gas again. Only this time, even harder. Several more trillions printed and distributed to citizens and businesses. The result was inevitable. Inflation. Prices jumped 8, 9, 10% annually. Money lost its value. So central banks started hitting the brakes. They sharply raised interest rates from 0 to 5% in 18 months. This was the fastest rate increase in history. And what happened? Withdrawal symptoms began. Banks holding bonds with low rates suddenly found those bonds had lost 30, 40% of their value. Several regional U.S. banks simply went bankrupt. Silicon Valley Bank, Signature Bank, First Republic, they had to be rescued to prevent panic. But here's the catch. If central banks continue raising rates, or even just keep them high to beat inflation, it will crash the stock market, the real estate market, and drive the economy into recession. Companies with massive debts won't be able to service them and will start going bankrupt. The U.S. government won't be able to pay interest on national debt. A chain reaction will begin. But if they lower rates again to help the economy and markets, inflation will return. And not just return, but potentially spiral out of control. Because each time they print money, the effect weakens while side effects intensify. It's like drugs. The first dose gives a powerful effect. The second is weaker. The third barely works, and withdrawal gets harder and harder. History tells us that in this situation, central banks always choose to print money, because it postpones catastrophe. Politicians and officials need everything to look normal right now. They don't want to be the ones presiding over the crash. Let it happen under the next administration. That's the psychology. Fed Chairman Jerome Powell says they'll handle inflation without recession. They call it a soft landing. Sounds nice. But in all of history, not once has any central bank achieved a soft landing after such debt expansion. Not once. Either inflation devours savings or crisis destroys the economy. There's no third option. This isn't a matter of opinion. It's mathematics. Think of a seesaw. Inflation on one side, recession on the other. The central bank stands in the middle trying to maintain balance. But the seesaw keeps swinging wider, and holding it becomes impossible. At some point, they'll simply fall. The question isn't whether they'll fall. The question is, which direction and when? And while central banks struggle with this dilemma, a far more terrifying threat is growing in the shadows that almost nobody is talking about. This is the shadow banking system. And what I'm about to reveal will shock you. When people think about the financial system, they picture banks. Big buildings with columns, ATMs, loans, deposits. But that's just the tip of the iceberg. Beneath the surface lies a giant shadow system 3 times larger than regular banks, operating by its own rules. Shadow banks are hedge funds, private equity funds, insurance companies, pension funds, various financial structures with names like special purpose vehicles. They don't accept deposits from the public and don't follow the same regulations as normal banks, but they make loans, trade securities, create incredibly complex derivative instruments. The total size of this system exceeds $100 trillion. For comparison, global GDP is around $110 trillion. Why is this dangerous? Because this system is opaque and interconnected by thousands of threads. Fund A owes Fund B, which owes Fund C, which owes Bank D, which owes Insurance Company E. If one link breaks, they all break. And nobody knows where these links are, or how strong they are, because the information is confidential. Regulators can't control this because legally these structures operate outside their jurisdiction. The most vivid example is long-term capital management, a hedge fund that in '98 nearly brought down the entire global financial system. The fund was managed by two Nobel Prize winners in economics, supposedly the smartest people, most complex mathematical models, everything calculated. But they made bets with 30-to-1 leverage, meaning for every dollar of their own money, they borrowed $30. When the market moved the wrong way, the fund started losing billions per day. In a few weeks, they lost $4.5 billion. If not for emergency Fed intervention forcing 14 major banks to pool money and save the fund, cascading collapse would have begun. Banks that lent money to the fund would have gone bankrupt themselves, then down the chain. That was one fund. Now there are thousands, and they've become much larger and more aggressive. And there's one specific scheme holding up a huge portion of global markets that could explode at any moment. It's called the yen carry trade. And this could be the trigger that brings everything down. The concept is simple. In Japan, interest rates have been near zero or even negative for the past 20 years. Investors borrow in yen practically for free, convert to dollars or other currency, and buy income-producing assets, stocks, bonds, real estate. The difference between loan cost and asset returns is pure profit. Sounds like free money, right? And everyone does this. Hedge funds, banks, corporations, even ordinary Japanese housewives invested pension savings through such schemes. The total volume of this scheme is estimated at $20 trillion. $20 trillion that depends on the Bank of Japan keeping rates low and the yen staying weak. But this summer, the Bank of Japan raised rates for the first time in many years, just 0.25%. And what happened? Markets worldwide fell 5% in 2 days. Why? Because investors realized, if rates in Japan rise and the yen strengthens, the scheme stops working. They need to urgently close positions, sell assets, repay yen loans. And when everyone starts selling simultaneously, prices collapse. That was a warning shot, a light tremor. The Bank of Japan got scared and said they won't raise rates sharply anymore. Markets calmed down. But the problem didn't go away. Japan can't keep rates at zero forever. They have their own inflation, their own economic problems, an aging population. Sooner or later, they'll have to act. And when that happens, $20 trillion will panic and look for the exit. It will be like a tsunami sweeping away everything in its path. Think of dominoes. Thousands of pieces arranged in an incredibly complex pattern. Just push one, and a chain reaction begins. The yen carry trade is that first domino. And it's already wobbling. Shadow system, debts, market bubbles. These are all separate pieces of one puzzle. And when you put them together, you see the complete picture. A picture of inevitable catastrophe. But here's the most interesting part. We've been through all this before. Not once. The history of financial crises is a history of human stupidity repeating itself again and again, because people are convinced this time is different. And what I'm about to tell you will prove that we've learned absolutely nothing from history. Tulip mania in 17th century Holland. Tulip bulbs cost as much as houses. People sold property to buy a bulb, believing tomorrow it would be worth even more. Then in one day, the market crashed, and thousands were left with nothing. The South Sea Bubble in 18th century England. A company promising fabulous profits from trade with South America, though no trade actually existed. Shares rose 20-fold in a year. Everyone bought, from common workers to ministers. When the fraud was exposed, shares dropped to zero in months. People committed suicide. Parliament passed a law prohibiting the creation of public companies without government approval. The law lasted 100 years. The Great Depression of the 1930s. Before the '29 crash, Everyone believed the stock market would rise forever. Ordinary people took loans to buy stocks. Banks gave loans secured by those same stocks. When the market started falling, margin calls began. Investors were forced to either add more money or sell shares. Everyone started selling simultaneously. The market fell 89% over 3 years. A third of banks went bankrupt. Unemployment reached 25%. People lived in cardboard cities and stood in lines for free soup. But even that didn't teach the lesson. In 2000, the dot-com bubble burst. Everyone believed the internet had abolished old economic laws. Companies with no profit, no revenue, not even a product were worth billions because they had .com in the name. Pets.com, a company selling pet food online, was worth $300 million with annual revenue of $6 million and losses of $20 million. When investors sobered up, companies started going bankrupt by the dozens weekly. The Nasdaq index fell 80%. 7 years later, the mortgage crisis. Everyone believed real estate was a safe investment that couldn't lose value. Banks believed it so strongly they gave mortgages without income verification to people without jobs, and sold these loans to other banks, packaging them into complex financial products rated AAA. When people stopped paying, it turned out these supposedly safe securities were actually toxic garbage. Lehman Brothers, one of the world's oldest investment banks, went bankrupt over a weekend. Bear Stearns disappeared. AIG, the largest insurance company, was on the brink of collapse. The Fed had to inject $700 billion taxpayer dollars into the system to prevent total collapse. And you know what people said before each of these crises? They said, "This time is different. Tulips are a new form of wealth. The internet changed everything. Real estate always goes up. We have a new economy. Old rules don't work. We're smarter than previous generations. We created a system that can't break." Those 4 words, "this time is different," are the most expensive lie in human history. Every time they're spoken en masse, catastrophe is already at the door. Because the laws of mathematics and human psychology don't change. Debts must be repaid. Bubbles burst. Greed turns to fear. And when fear comes to markets where everyone was playing one direction, a stampede begins. Right now we're hearing those same words. Look, analysts say, we have artificial intelligence, digital economy, central banks learn to manage crises. We have tools that didn't exist before. This time is different. And millions believe it. Believe their pension savings and index funds are safe. Believe their home will be worth more in 5 years. Believe the government will find a way to handle the debt. But let's face reality. Mathematics doesn't lie. If debt grows faster than the economy, it's unsustainable. If interest on debt soon becomes larger than all revenue, that's collapse. If assets are worth 3 times more than the entire economy produces, that's a bubble. If the shadow banking system created mutual obligations worth hundreds of trillions and nobody knows who owes whom, that's a time bomb. Each of these factors individually is a serious problem. But right now they're all operating simultaneously. It's like having liver, kidney, and heart failure at the same time. You can save someone if one thing fails. But when everything fails at once, there's no chance. And here's what you need to understand. Because this will determine whether you survive what's coming or become another casualty. What's worse? The modern financial system is designed so that crisis will unfold at incredible speed. In the 30s, the crash took 3 years because everything was done manually. To sell stocks, you had to call a broker, he'd go to the exchange, find a buyer. Now 70% of all trades are executed by computer algorithms. They react to falling prices in milliseconds. If the market starts falling, algorithms will start selling. This will cause further decline. Other algorithms will see the decline and also start selling. A feedback loop will emerge that accelerates the fall to unbelievable speeds. We've already seen this in miniature. In 2010, the flash crash happened. The Dow Jones dropped 1,000 points, 9%, in 5 minutes. Simply because one algorithm started selling, others followed, and panic began. In 20 minutes, everything returned because regulators stopped trading. But think what will happen when the decline is justified by real fundamental problems. not a technical glitch. You can stop trading for an hour, a day, but you can't stop mathematics. So what happens next? Let me put all the pieces together and show you how the collapse scenario might unfold. And pay attention, because understanding this could save you. The trigger could be anything. It could be a major hedge fund bankruptcy that couldn't close its positions. Could be a Bank of Japan decision to sharply raise rates. Could be a default by some country with large debt. Could be a series of bad economic data showing recession already started. Could be a geopolitical crisis disrupting trade flows. The specific event doesn't matter much. What matters is the system is so overloaded with debt and overvaluation that any shock can trigger a chain reaction. First, stocks will fall. Not 3% like we're used to seeing in the news, but 20-30% in a few days. Investors who bought stocks with borrowed money will get margin calls. They'll have to sell. Pension funds with risk limits will also start selling. Algorithms will follow. The decline will accelerate. Next come problems in the corporate sector. Companies that refinanced debt at low rates 5 years ago will now face the need to refinance at 7-8%. Many won't be able to. Bankruptcies will begin. Mass layoffs. Unemployment will spike sharply. Consumers already sitting on maximum credit card debt will start defaulting. Banks will face a wave of non-payments. Their capital will start evaporating. Regulators will try to intervene, but they'll discover the problem is much bigger than they thought. Several banks will go bankrupt. Panic among depositors will begin. People will rush to withdraw money. Banks won't be able to give everyone cash because most money exists only electronically. The government will impose limits on cash withdrawals. Simultaneously, the real estate market will crash. Mortgage rates are already around 7%. When mass unemployment begins, people will stop paying mortgages. Banks will start foreclosing and putting houses up for sale. But there won't be buyers because everyone has problems. Real estate prices will fall 30, 40, 50%. Millions will be underwater. Their homes worth less than remaining mortgage debt. The government will try to intervene. The Fed will cut rates back to zero and start printing trillions again. But this time it won't work, because confidence in the dollar will be shattered. Other countries will start dumping dollar reserves. The dollar will collapse. Inflation will return, but not 8%, more like 20, 30. People's real incomes will be cut in half within a year. Stagflation will emerge, simultaneous economic decline, and high inflation. This is the worst possible scenario because all tools work against you. To beat inflation, you need to raise rates, but that kills the economy even more. To support the economy, you need to lower rates and print money, but that accelerates inflation. Social consequences will be catastrophic. When people have no jobs, no savings, and prices are rising, they take to the streets. We saw this in Greece during the debt crisis. Saw it in Argentina. Saw it during the Great Depression. Political systems start cracking. Populists emerge promising simple solutions to complex problems. The search for scapegoats begins. Tension grows between countries, between social groups. This isn't fantasy. This isn't alarmism. This is simply the logical continuation of current trends. Everything I described has happened before separately. Debt crises, banking panics, stock market crashes, social unrest. The difference is this time all these factors converge together and the scale will be global because the world economy is now connected like never before. I understand this all sounds grim, very grim, and the natural reaction is denial. To think, it can't be that bad. Someone will figure something out. Authorities won't allow it. The economy will adapt. But that reaction is exactly the main problem. Because while we deny reality, nothing changes. Bubbles keep growing. Debts keep accumulating. And the longer we postpone the moment of truth, the more painful the fall. Does this mean you should panic, sell everything, and bury gold in the backyard? No. Panic is a bad advisor. But ignoring risks is stupid. So what should an ordinary person do in this situation? And this is absolutely critical. First, acknowledge reality. Don't believe the TV, the government, or financial analysts who get paid to say everything is fine. Look at facts, at mathematics, at history, and draw conclusions. Second, minimize debt. If you have a credit card with a large balance, find a way to pay it off. Yes, it's hard. Yes, you'll have to tighten your belt. But when crisis comes, debts become an unbearable burden. People who in 2008 lost their jobs with mortgages lost their homes. Those without debt survived the crisis with scratches. Third, create a financial cushion. Cash. Not in a bank account, but actual physical cash at home. For 3-6 months of basic expenses. When banks close or limit withdrawals, this money will save you. Yes, inflation will eat it. But better to lose 20% to inflation than be left with no money at all. Fourth, diversify assets. Don't keep all eggs in one basket. If all your savings are in stocks or one apartment, that's huge risk. Some in cash, some in physical gold or silver that has preserved value during crises for centuries. Maybe some in cryptocurrency if you understand the risks. But mainly, don't depend on one asset class. Fifth, invest in skills. In crisis, those whose qualifications are easily replaced lose jobs. If you can do something valuable that people always need, food, repair, health, you'll survive any crisis. Learn. Develop. Your skills are an asset that can't be taken away. Sixth, build connections. Community. In hard times, it's not loners who survive, but people with a support network. Family, friends, neighbors, professional connections. Help others now, and they'll help you later. And most importantly, don't let fear paralyze you, but don't let complacency lull you either. Yes, the world may change dramatically in coming years, but people have survived worse. The Great Depression, world wars, hyperinflation. And those who were prepared, who maintained clear thinking and acted rationally, not only survived but found new opportunities. Crises are also times of opportunity. When the old crumbles, space appears for the new. After the Great Depression came Roosevelt's New Deal, which created the middle class in America. After World War II emerged a new world order. After the 2008 crisis came new technologies and companies. Those who had money and courage to buy stocks at the bottom in 2009 multiplied their capital tenfold in the following years. So yes, difficult times ahead. Very difficult. The system built over the past 50 years has reached its end. It's impossible to reform from within because those in power and those benefiting will do everything to preserve the status quo. Change will only come through crisis, through cleansing. It's painful, it's scary, but it's inevitable. Mathematics doesn't forgive mistakes. You can delay reckoning by pushing problems into the future, but you can't avoid it forever. Sooner or later, the bill comes due. And the longer we delayed, the bigger that bill. I'm not calling on you to sell everything and move to a bunker. I'm calling on you to open your eyes, look at reality soberly, and prepare. Because those who are prepared will survive the storm. And those who believed this time is different will lose everything. History doesn't repeat, but it rhymes. And right now, it's rhyming with the darkest chapters of the past. We stand on the threshold of changes that will reshape the world. And the only question is, will you be a victim of these changes or someone who uses them as opportunity? Share this video with those you care about, not to frighten, but to warn. Knowledge is a weapon, and preparation is armor. In coming years, we'll need both. Remember, empires don't fall because their enemies are too strong. They fall because they stop seeing their own weaknesses. Because elites start believing in their exceptionalism. Because ordinary people are lulled by the illusion of eternal prosperity. And when reality finally pierces that illusion, it's already too late. Don't be those who wake up too late. Time to act is now, while there's still time. Because when the clock strikes midnight, options will be gone. And all that remains is reaping the fruits of decades of irresponsibility and self-deception. Thank you for watching to the end. Take care of yourself and your loved ones. And remember, one prepared person is worth 10 unprepared. Be that prepared person.